The broadcast is now starting. All attendees are in listen-only mode.
So, good evening, everyone. And first of all, thanks a lot for joining. I know has been on a short notice, in fact, for the entire investment fraternity because the changes were less expected. But, anyways, so thanks once again for joining. This session is a quick session in terms of what are the changes happening in the debt market and especially a non-equity products. So I'll quickly run through you few very limited slides and I'll try to explain what is changing now and for somebody who's investing now and somebody investing after 1st of April or from 1st of April. So yeah, so as you can see on the screen, the Finance Bill to 2023 has proposed the amendments in income tax laws with effect from 1st of April 2023, whereby investment in debt mutual funds, will be treated as will not get tax benefit primarily. So what does this means? Any fresh investment which is made after 1st April 2023 will not get benefit of cost indexation and concessional long-term capital gains tax. How does it impact? So this impacts in a way where each of the investment which is made in a debt fund, any fund which has an exposure of less than 35% into equities will be treated in as per your marginal tax rate. What is your marginal tax rate? It is the rate at which you are presently paying taxes. So as per your income slab, if you are paying your taxes at the 10%, 20%, 30%, 35% with surcharges, there it could be little more. So that is the tax rate which will be applicable on the income. When I say income, that is whatever you have gained from your investment in a debt fund as a part of capital appreciation or as a part of dividend, that will be treated as per your marginal tax rates. Second point, gains will be treated as short-term capital gains by default and tax slab as rate are irrespective of the holding period. So there is nothing long-term, short-term, whatever you are holding for whatever number of years, that is immaterial after 1st of April. So any investment which is made prior to 1st of April will fall into the same category of long-term capital gain, will have that benefit. I'll move to the next slide where I explain how does that makes a difference, but I'll just redefine the above definition. What is kept: the equity exposure of not more than 35% of total corpus in domestic equity. So what does this mean? This means debt mutual funds on a broader side. It also includes commodity related fund like gold fund. This also include fund of funds. So fund of funds, fund of fund as a concept is a fund which is accumulating money and investing into 2 or 3 different asset classes or within subcategories of funds. So it could be a fund of fund investing into international equities, a fund of fund investing into, take for example, multiple ETFs and multiple asset classes, say equity, debt. So all those fund of funds also, if they are not meeting this criteria of 35% investing into domestic equity shares, they will be treated as debt and their taxation will also get changed from 1st of April. So that's where instead of debt, I have redefined to a special categories. That was the reason I was pointing out to. I'll move to the next slide. What is indexation all about and how it is benefiting you so far, or probably till investments in next 2 days. Now, it's a very simple example which you can see on my screen. So on an investment of 1 lakh rupees, if you are investing 1 lakh rupees for 7 years in an instrument or a debt fund which is yielding 7.25%, and similarly you are investing 1 lakh rupees into a traditional fixed return product, say a fixed deposit, the yield or the interest rate at In both the cases, at one case it is 7.25%, the second case it is 7.5%. So 1 lakh invested after 7 years has become 1,63,223, whereas 1 lakh invested into a fixed income product like an FD, cumulative FD, has become 1,68,226. Now the 63,000 rupees gain in the debt fund category get the indexation benefit. When I say indexation benefit, so the 63,000 is the gains after indexation. So if the indexation in this 7 years or the inflation indexation numbers comes from the government, so how the index is moved, index is very much dependent on the inflation numbers. So if the inflation has been high, the index itself will move, and net of index, so suppose the 100 rupees index has gone up to 120, so that's a 20% move, so that gains will be reduced. So to that extent you don't have to pay taxes, and then whatever is left out you have to pay 20%, and plus surcharges and all, you have to pay 23.92% post indexation. So in this example, if somebody has invested 1 lakh rupees in a debt fund, that fund, the total accumulated value has now become 1,63,000 rupees, and the investor is withdrawing. So on the withdrawal, indexation will get applied, and effective rate for him post indexation will be 23.92. So that result into an actual tax outgo of 9,000 rupees only. So the post tax returns in this kind of a scenario will be 1,63,000 minus whatever tax you have paid is 1,54,000. So this is what is indexation benefit and how it impacts your overall returns. Now I'll give you come to the next section, where if somebody has invested 1 lakh rupees, same 7 years, 7.5% on a fixed deposit which is maturing or cumulative. So on maturity you get 1,68,000, and assuming that you are on the highest tax bracket of 35.8%, which is including surcharges, so you have to pay on the 68,000, you have to pay 35%, 35 or 36% nearly as a taxes. That makes the outgo or tax outgo to 24,480. So what you are left with is 24,000. You reduce 24,000 from 168, and then you are left with 1,43,747. So that is what the impact is. You can see the difference in a debt fund or a fund of fund currently. So when we say if I have to redefine both the columns into one, debt fund till 31st March 2023, and instead of traditional fixed returns, I can say debt funds post 31st March or from 1st April 2023 onwards, the taxation will shift to the other side. That shows a phenomenal change in terms of your post-tax returns. So this is what the market is all talking about. There is a lot of investors who have already started investing into debt fund category for long term, so that any investment which is made till 31st March, for us the cutoff time is till 2 o'clock, you will get the indexation benefit in terms of your taxation. So it makes very fair, I'll not say advice, or it's a very fair decision. If you want to park some money into debt funds, this is the right time. You can do it today, tomorrow, before by maximum 31st, to get this indexation benefit. Something very similar to what we have seen when the tax was introduced on long-term capital gains on equities, where the previous investments were grandfathered. Similarly here also, any investment which is made till this financial year, that is 31st March 2023, will be grandfathered for long-term indexation benefit, whereas any investment made after that will be treated just like any fixed deposit product, which is like your FDs and bonds, where you have to pay tax on the interest payment and on capital appreciation as per your tax rate. And there is nothing called long-term capital gain. Everything will be taxed as per your income tax rates. I hope I'm very clear. I'm able to explain this. If any one of you still have some doubts, you can post this into your question in the question section, which is there. And after that, I'll probably retake your question and answer that. I'm moving to the next slide. So now what next? What next is if you have understood the concept, now there are few funds which are part of our recommended basket, which we want to showcase to you. Are HDFC short-term debt fund, HDFC corporate bond fund, and HDFC Nifty SDL. SDL is state development loans, which is maturing in October 2026. It's an index fund. Now I'll give you a little brief about it, why we are saying you can park into any of these three. Or first two are a regular ongoing active funds. What does that mean? That means that these funds will be there forever. They have been there in past and they will continue to live forever. These are actively managed funds. The current YTM, what is stated above on, as you can see on the name, is yield to maturity. The current YTM of this fund is 7.8%. 7.88% in one and 7.8% in the second. What does this mean? The overall holding, so any fund, debt fund, just to tell you, holds a lot of debt papers. These are quality papers of high rated companies, AAA companies, which they are holding. So the average yield, so some paper may be holding, maybe giving them a yield which is as an interest rate for simpler terms. So you have one paper which is giving an interest rate of 8%. You have another paper which is giving you an interest rate of say 7.9%. Then you have certain paper which is giving you 7.7%. But the overall average yield at this point in time, which is as of 24th March, the yield to maturity of these paper is 7.88%. And now I'll move to the second section, which is average maturity. Average maturity means that whatever papers these funds are holding, when are they maturing? Are they maturing very soon? So how does this impact? This impacts an investor as in, take for example, if I have bought a paper of at 100 rupees, which is giving me 9%, when it is maturing next year. So once this paper matures next year at 9%, I'll get that 100 rupees will become 109. That 109, when I'll receive that 109, I will further invest it. So if there is now, when I'll further invest this fund, there is an reinvestment risk. When I say reinvestment risk, when next year when I'll receive this 109 rupees, I may the interest rate scenario could be different. I may get a fresh paper or fresh investment opportunity at an 8%. I may get at 7%. I may get at 10%. So that is a reinvestment risk. So if somebody is looking forward for a longer duration, so for him it makes sense to buy a fund which has average maturity of longer duration. So average maturity of, like as you can see in your screen, average maturity of HDFC corporate bond fund is 5.3 years. That means total number of papers which they have, on an average they are maturing in 5 years. So there will be some papers which are maturing in 3 years, 2 years and 4 years, and there are other set of papers which are maturing in 6 years, 7 years, 8 years. So average maturity is 5.3 years. And as and when these papers mature, they are further invested, and the further investment rate of interest is dependent on what is prevailing in the market. Very similar to like today, if you do a fixed deposit, you may get 7%, but 1.5 year, 2 years back, if you're doing a fixed deposit, you would have got 5.5% to 6%. So the interest rate scenario has changed. That's why you are getting better interest rate. So that's where these price fluctuate. Now, how an investor should approach? Ideally, if you want to participate into debt funds for long term, and there's no defined horizon, but yes, you need liquidity and you want to participate, but definitely beyond 3-4 years. So you can park into these two opportunities, split between these two. If you are very sure that you want to go for little longer durations only, you can go in for 100% investment in HDFC corporate bond fund. If you want to split your investment, you can split between the two, because short-term funds will be hovering around 3.5 4 years, and corporate bond fund has the flexibility to add little more duration. It may also happen that when the interest rate scenario is like currently we are into a high interest rate scenario, we may move into a low interest rate scenario. The fund manager can reduce down the average maturity, so that if he foresees that probably rates will be more attractive after some time, so he may have he has the flexibility to reduce it. But all that is done by a fund manager. You as an investor has to just remain invested in this fund. Just to give you, HDFC corporate bond fund is an old fund. It has given uh, since inception almost around 8% kind of a returns. But yes, over a shorter duration, 1 year could be different, 3 years could be different. So but if you are holding for long, so if you are in the age bracket of say 40 45, or your investment horizon is 10 12 years 15 years, you can uh, stay invested in these kind of a funds, and they will be giving you uh, probably a stable kind of a performance. When I say stable, that I'm not saying that they won't be volatile, but over a long run, yes, whatever the prevailing rates are, they will be moving as per them. Now the third fund, which I've stated out here, HDFC Nifty SDS State Development Loan October 2026 Index Fund. What is this? This is a fixed has a fixed maturity. It's a targeted maturity fund. So this fund will mature in October 2026. So that's 3 years from now or 4 years from now. So this is a fund which is a fixed maturity or targeted maturity fund. You invest today. As the time passes by, your maturity will keep on coming nearer, and at the end, your 100 rupees with this 7% kind of a growth. I'm assuming 7 overall. So next 3 years, 21%. So 100 will become 121, and your maturity will happen. You will get the indexation benefit, as I've told you earlier. Uh, that benefit will be there. The only caveat is, after that you have to invest into any other prevailing fund if you don't need if you don't have presently a targeted expense for this maturity amount, and then that amount that fund which you receive need to be put into if you want to replace into debt, then in that scenario debt taxation will be different, and I'm just assuming that after 3 4 years the debt taxation will remain the same, but it will be applicable at that point in time, whatever the debt taxation is. But if you are an investor who just want to park some funds into debt market, the HDFC short-term fund and the corporate bond fund makes very fine sense to you, because you are splitting your funds. These are actively managed funds. There is no lock-in in these funds. Yes, for tax advantage, for being for getting a uh, long-term capital gain taxation, you have to remain invested for 3 years or more. But there is no lock-in as such. So you can understand the fund. Go to our website, just write their names. You will get entire details. I'll just show you also, and then you can take your decision of investing. But the only thing is that if you are investing before 31st of March, you will get indexation benefit. If you are investing after 31st of March or from 1st April onwards, this indexation benefit will go away. Then this fund will be as similar to investing into fixed deposits and all. So those options are available. We'll do another session in terms of what are other investment opportunity in the fixed income sites which HDFC Securities offers to you. So I'll just move to another slide where I'll give you a slight comparison about how these funds pan out with the among each other. So the first fund, target maturity fund, liquidity, yes. Redemption and subscription both is possible on any business day. It is not of, when I say target maturity, it does not mean it's a locked in fund. You can redeem at any point in time, but your redemption date of redemption will define which kind of taxation you will be applicable for. Compared to fixed deposit, you can redeem only on maturity, or you have to pay penalty for early exit. Third is active debt fund, which are our short-term funds and corporate bond funds. That too also you can redeem at any point in time. Tax efficiency. When I say tax efficiency, this is applicable till 31st of March. Indexation benefit for more than 3 years. Fixed deposit don't have tax efficiency in terms of long-term capital gains. And excuse me, active debt funds also have indexation benefit for more than 3 years. Tenure in target maturity, we have a fixed tenure, something which is maturing in 2026. Fixed deposit, yes, we have a defined tenure. Active debt funds, they keep on, it's an ongoing fund. It keeps on accumulating. Whatever the interest comes, that is also gets reinvested. So you don't have to do the withdrawal. You can just see the fund performing. Whenever you want to withdraw, you can withdraw partially, fully. That entire flexibility is in your hands. Diversification in terms of target maturity fund, yes, the fund does diversify itself into various SDLs, which is state development loans, which could be Andhra paper or UP power paper or various other government papers. FDs, in terms of diversification, yes, FD doesn't diversify because you do an FD with one specific entity. If it is a corporate fixed deposit, it could be HDFC Limited or Shriram, or if it is bank, it could be HDFC Bank or ICICI Bank. So there's no diversification out there. And active debt funds, yes, there is a diversification because each fund manager doesn't participate into only one script. They participate into around 40, 45, 60 scripts. Scripts as in papers which have different maturities. So lastly, duration risk. Yes, that's what differentiates between active fund and target maturity fund. Target maturity fund, there's no duration risk because as your time passes by, your time to maturity keeps on coming down, and finally your fund matures. So whatever the YTM you see, broadly somewhere around the same returns is what you get. There's no changes, so there's no duration risk. Fixed deposit, yes, it is not at all applicable. There's no duration risk. When I say duration risk, I'll try to re-explain you. When I say duration risk is if you are invested in a fund and that fund has certain papers which are maturing, so if in maturing after 3 years and the interest rate scenario changes after say 1 year down the line, that's what we have seen in last. That's why if you see most of the debt funds, the performance of most of the debt funds which have a larger duration of papers, which are maturing in 2 years, 3 years, 4 years, they have seen a lower single digit performance in last 1 year or 2 years, just because the interest rate scenario has changed. Interest rates have gone up. So each paper is marked to market as per the current rate, and that's where the duration risk comes. But if the maturity is nearby and there's no fresh money coming in, there's hardly any duration risk. So that's where active debt funds have a duration risk, and that's where their returns do vary. But looking at the current interest rate scenario, we are very near to the peak. I'll not say we have peaked, but they could be a 25 bips. That's our house view of can maximum be a rate hike. But beyond that, we don't expect much. But yes, you are entering into a very probably say lucrative yields at this point in time, where 7.7, 7.8 is the YTM, gross YTM of these funds. So broadly, this is what we wanted to address to you all. I will just flip on my screen. I'll share you. This is where you need to see the fund details. This is HDFC Corporate Bond Fund. You can go on HDFC Securities website. Just write the name. If I say HDFC short term. This is HDFC short-term debt fund, which we just spoke about. You can click here and you will see the performance Look, as I say, since inception it is 8%, 5 year has been 6.8%, so nearly 7%. But 1 year has been fun and 3 years has been bad. Bad as in relatively it's been low just because the interest rate scenario has changed. But when you are entering now, what you have to refer to is what is the current YTM from your date of entry, how it is going to perform, and where you can see the YTM is 7.8%, and which really makes this very attractive. So you can search the fund which you are looking forward for and participate. I'll move back to my slide, and that's broadly what we want to address. I'm happy to take up questions if there are any. Uh, but few things which I just want to summarize. This tax implication is for debt funds and all other funds which are holding less than 35% Indian equities or domestic equities, so to say. So which includes your fund of fund or any other fund for that matter, gold fund and all that. But anybody who has invested now, today or before 31st, still remains in the old tax regime, and he doesn't have to get. So on the similar lines, I just wanted to share you some of our other recommendations, which is overseas fund of fund, where again, if you are really very bullish on US markets, so DSP, US flexible equity fund. Obviously, this is investing into US equities, so it's not Indian equities. That's why it is still getting indexation benefit. It comes under debt taxation, but that's all is there till 31st of March. Kotak Global Emerging Market Fund. It invests into emerging market categories. So one is a US fund, another one is a emerging market fund, and the performance is fairly upfront on your screen. Other fund which are in part of this category, gold funds. Uh, you know, so any fund where you invest right now, which are in this kind of a segment, they will get indexation benefit if you have invested before 31st March. I'm happy to take on questions. So there's one question I'll quickly take you. I have a SIP in 5,000. I have a 5,000 SIP in retirement mutual fund. So, sir, if you have invested into retirement mutual fund, it is primarily an equity fund, and equity fund is not related out here. So you can remain invested. As far as the taxation is concerned, it will be a long-term capital gain because you are invested for long, and you won't get indexation benefit because you will get long-term capital gains, which is fairly at the current tax rate. You will be taxed at 10% of your capital appreciation minus the minimum 1 lakh rupees of gains. So if that is the only investment which you have done, you have say this for the benefit of everybody, I'm just referring to one of the question which has been asked. One of the client has invested in has done 5,000 rupees SIP into retirement fund. So retirement fund is a predominantly equity oriented fund, so it doesn't classify under debt, and your taxation will be long term equity taxation, which is at present it is 10%. So you have made a good choice, sir. So remain invested. You won't get indexation benefit, but still in any ways this fund is retirement. It's a good fund to work for. So I'll take second question. Second question which one of the client has asked is about liquid fund. They should also get indexation benefit. Yes, liquid fund also gets indexation benefit, but the construct of a liquid fund is you park it for short term. So if somebody is invested today in a liquid fund and he is redeeming those liquid fund after 3 years plus, you will get indexation benefit. But normally people invest into liquid fund for a very shorter term. That's how the nature is, around 15 to 30 days or something like that. So if your investment horizon is that long, and I think liquid fund may not be the right choice. But yes, as for taxation your question goes, yes, you will get indexation benefit. I'll just take up other questions. Just a sec. Okay. Any hybrid fund where we can get indexation benefit? I'll, I'm just quickly taking on the question. So anybody who has asked this question, I'll just answer you. Any hybrid fund where one can get indexation benefit? So way forward, uh, after 1st April, or from 1st April, there won't be indexation benefit, but hybrid fund like the balance advantage funds and hybrid funds are for equity taxation, and where you get 10% long-term capital gains, and short-term is anyway as per marginal. And since if you're planning to invest into equities, that means you are investing for long-term. So sir, you can invest into any of the hybrid funds of a recommended basket, and you will get index. You will not get indexation benefit, but your long-term capital gains is 10%. So it is fairly lower than your indexation benefits. So it still makes sense. You should go as per your risk profile, and uh, I'll read out another question. If I invest on 1st April in a debt fund, will it be taxed the same as fixed deposit? So there will be no difference if I invest in a fixed deposit or a debt fund. Yes, Mr. Duggal, yes, this will be the case. The only difference, uh, uh, there won't be any much difference. The only thing is, if in a fixed deposit, you have two options. You can take uh, interest payout or interest or cumulative interest. In a debt fund, if you have opted for a growth option, the day you redeem, so if you redeem after 2 years or 3 years, on that day you have to pay taxes, which will be as per your marginal tax rate. In fixed deposits, if you're accruing interest, you have to pay tax accordingly. So yes, it remains broadly the indexation. There won't be any indexation benefit. The taxation will remain same. So if you are expecting some funds post or after this closure of this year or after 31st March, fixed deposit and debt funds are comparable. There is no tax advantage which debt funds will carry. Then there is a question: what is the probability of AMC changing existing debt funds characteristics? Uh, look, for AMC to change a debt fund characteristics, they need to change the objective of the fund, and that requires exchange approval, and it should not coincide with the existing. So all debt funds can't be made hybrid funds, because a fund in AMC can have one fund in one category. So if he has an aggressive hybrid, it can have another fund which is a different category, which is conservative hybrid, or but beyond that you can't go. So the funds, not all the AMCs and not all the funds will be changed. There could be minor tweaking in some funds, but if the fund objective clearly states that they won't take exposure to equity, they will not take just for the sake of beating out this, because there's already investors who have already participated out with looking at the present objective. So less likely, sir, if that going to happen. Now there's one more question. How about credit risk fund? Yes, credit risk fund are a decent opportunity. They offer little higher than the normal AAA rated funds. The fund manager takes the call basis his understanding on the financials of the company, which are AA rated, AA plus, or AA minus, basis his understanding of the credit rating. There, in credit risk fund, the returns are generated because you get a little higher interest rate compared to a AAA rated paper and a AA plus rated paper or AA rated paper. Secondly, if the company is good, it there is an upgrade of the company by rating agencies that really helps to generate an alpha over it. But on the downside, there could be a possibility, and a AA rated company can be re-rated to A plus or A minus. So that is again a risk. But yes, you can, if your risk appetite allows you, you can participate into credit risk fund. It will follow again in that category of debt funds, and indexation will be very similar. If you're investing now, you'll get indexation. Post from 1st April, you won't get it. Uh, bonds have same index benefit as debt mutual funds? No, bonds don't have indexation benefits. So there's one question. I understand capital gains up to 1 lakh is exempted in case of mutual fund redemption. Capital gains of 1 lakh is exempted in mutual fund redemption for equity. Not in fact, it's not only mutual funds. Equity up to 1 lakh rupees. If you have invested into equities, long-term capital gains up to 1 lakh rupees is exempted. Above that, you have to pay 10% taxation. For other finer details, you can check with your CA, but that's the broader rule is. Uh, so there's one more question. So for all the customers who are there, I'm just reading out the questions and just trying to answer it. So from 1st April, there will be no difference investing in a debt fund or fixed deposit. Understand that FD may have penalty for early withdrawal, but nothing other than that. Yes, your question is right. Okay. I understand the benefit can be obtained only by for lump sum investment, not by SIP. Yes, yes, sir. Your understanding is right. Whatever you have invested till 31st, you'll get this kind of a tax regime. When you pass this financial year, then it will be a new tax structure. Can investment in MF be directly through the HDFC? Yes, you can invest through HDFC platform. Yes. So does target maturity fund have end date and then it is not available for investment after that? So target maturity funds have an end date, but they don't have an entry date. So it becomes it's not a close-ended fund. It's an open-ended fund. So there are list of target maturity funds which are available on the website. In fact, for all the investors who want to have a larger basket of our recommended list, can go to our website and our app. There's a recommended download the report. You can download our MF recommendation report. You will see a list of funds there. So and you can choose any one of it. So there is a long list of target maturity funds having maturity from 2026, 27, and in fact 7-8 years also. I'll share it over the screen if the time permits. Okay, this I have gone through. How does an open-ended fund maintain the same YTM? Open-ended fund doesn't maintain the same YTM. The YTM also hovers between whatever is the interest rate scenario. Just to give you an example, like the corporate bond fund which we are talking right now, which is yielding 7.8%. If somebody look back 1 year and say probably this corporate bond fund would have been offering around a YTM of around 6.8, 6.9. 2 years back, it was a different interest rate. So the YTMs of the corporate bond fund, when we say it is 7.8, that is as in this point in time, and they don't maintain. They also the YTMs also fluctuate within time. But yes, if you have invested today, there is a very high probability that you'll not be very close to the YTM, but yes, you have got into a better rate compared to somebody who has done last year at a YTM of around 6.5%. So there's no constant YTM in an open-ended equity or a like open-ended active debt fund. So can you compare the YTM of GSEC fund with similar average maturity? I will just showcase you what all GSEC fund which we are offering, and you can decide which you want to. But again, as the GSEC papers keeps on coming up, the average maturity and YTM will fluctuate. How does an open-ended fund maintain YTM? I've answered this question. Will the future SIP installments come under indexation? No, they won't come under indexation. Do you think the yields on the debt fund will increase after 1st April to be able to compare the fixed rate instruments? If yes, then will that make them be riskier? Look, the yield on the debt funds are not dependent on the demand from the investor. They are more dependent on how the market is behaving, what is the prevailing interest rates, and what are the corporates are offering. So they even if you see currently, like on a platform also, we are offering uh, a fixed deposit at 7.7% of HDFC Limited. So somebody who wants a fixed maturity or a fixed returns, a clearly defined fund, you can participate out there. But yes, that will mature. So the yields will keep on moving, hovering as per the prevailing market rates. This Okay, what is the exact link of that report? Sorry, I can't understand. So again, indexation for ultra short term funds is the same. Any debt fund, liquid, ultra short term, corporate bond fund, credit risk fund, gilt fund, longer maturity fund, all these funds, when they classify themselves as debt category, and all of their taxation will change from next year onwards. Uh, So there's a question on, so HDFC Securities doesn't recommend. So currently, as per our guidelines, we only represent AA plus or AAA rated papers, knowing the risk associated with, and so that's why that's the restriction which we have currently, and we want to stick on to that for some time. We may offer it, but I'll say it's a question on. There's an investor who has asked why we are not offering India Bulls NCD. So currently, HDFC Securities, we are offering only AA rated, AA plus rated papers. So that's it. And just for the benefit of some of the questions which has been asked, I'll just run past through you in my presentation in terms of long dated. So you can, for all the investors who are there, you can download this reckoner, which is available on our mobile app or in the mutual fund section, where you can say download mutual fund reckoner or report. It is there on the website, it is there on the new mobile app or the old mobile app. Though I request each one of you to download our new mobile app, which is far more responsive, far more helpful for all our investors. We have got very good feedbacks. So I'm just taking you through some of the opportunities which are there on target maturity fund, because that was one of the question. So there are papers like, if you see Kotak Nifty SDL, which is maturing April 2032. So this is a very long dated paper, and it's the YTM is 7.8%. The average maturity, so paper which they hold is 8 years. So this is something, if somebody is looking for long term on the target maturity side. And so these are certain opportunities which are there. And this on the gilt side, as I believe somebody has asked questions. So these are the 3 gilt funds which are part of our recommended basket. SBI Magnum Gilt Fund, which is a 7.5% YTM for 11.8 years. So somebody who's really looking for very long term, this is the fund. But yes, it will come with its own fluctuations, because the longer the duration, the more impact on the shorter term returns is. So please discuss with your relationship manager or advisor that you want to participate in the longer duration or shorter duration. So this list is anyways available. All the investors can download through our website or app, or they can write to us. We can forward that to them. I think I have finished up all the questions. So thanks a lot for joining in, everyone, and it was really a pleasure to share this experience or knowledge with you, and hope you invest and hope you take the best advantage of the little time which is left before this year close. Thank you everyone for joining.
Yes, thank you, Abhishek. Thank you, customers, for joining us.